ChatGPT that triggers a lot of demand for all these high-end computing chips, high-end network infrastructure, all this stock that benefits from all these strong catalysts or industry theme, right? It's a very good opportunity during a pullback for you to get in at very good price. So.
All right, welcome to the Q1 market updates in layman's terms, right? I'm Yongxing, your host for today. Now, before we bring on Chye, let me go through a few things with you today. Now, we just want to make sure that you know we are not a licensed investment advisor, right? And we do not manage our customers' fund. We are an educational institution, so our purpose here is to educate you so that you can make your own decisions and be your own investment manager, right? That way you have a better control over your decisions and be able to get better results. So if you're looking for stock tips, and this is not the place for it. Now, all the information that we share here are meant for educational purposes only and must not be taken as a recommendation to buy or to sell.
So hi everyone. So good evening everyone. So I'm Chye from Beyond Insights. So I'm a financial market analyst in Beyond Insights. So before we start, let me have a quick check. So how many of you over the past have been struggle about like what happened in the stock market and also about the financial jargon where you find it complicated to understand? You may type in the chat whether you feel is complicated for all the financial jargons or you cannot get clear of what happened in the stock market. You may type yes in the chat. Let's say you feel that it's always very difficult to understand all the financial jargons. Okay, so seems most of you have some experience, or yes, I see some, yes, financial jargon is hard to understand. So don't worry, because this session is arranged to be inclusive of beginners. So whenever I talk about all these financial jargons, I will use as many layman terms as possible to keep it simple. And also, I hope that this session will be as interactive as possible, so that whenever I post the questions, I hope that I can get a response from you from the chat itself. And I also hope that you can participate as much as you can throughout the sessions, because this session is arranged specially for you. And lastly will be, before we start, the market is dynamic. So whatever we share today here is based on the current development and also the latest data as of end of Q1 2023. So if things further develop or things change over the next few weeks or months, then the scenario will be different and things may change. So do you agree on that? So things may change if, let's say, there are further development. Okay, so let's start. Okay, so before we start this, let me launch a poll here to check whether you are actively trading in the stock market. So let me launch a poll here. So how many of you have been actively trading in the stock market? You may click yes. And if you are not trading before or you are not actively trading or investing, you just click no. Okay, I see most of the poll answered no. So I'll use as many layman terms as possible and explain as many financial terms as possible when I go through all the slides here on the market update itself. All right, thanks for participating the polls. So the objective of this session is to update you on the latest events and factors that affecting the stock market currently. So this is the first part of this presentation. And the second part will be navigating the market and identifying potential opportunities. So after we understand what happened in the current market, then I will share with you what are the potential opportunities ahead for this Q2 or coming Q3 and 4 for 2023. So as an investor or trader, usually we take on a look on the big picture first. So we want to understand what happened in the stock market first before we navigate the market and identify the opportunities. Okay, so there are a few key topics we are going to go through today. So number one will be inflation-related data. So I will cover some inflation-related data. So before we go into the inflation or next topic, so what is inflation? Anyone would like to type in the chat, what is inflation? For those that know what is inflation, do you mind to type in the chat so I can know how many of you understand that? Okay, so inflation in general, it refers to the rise in price of goods and services. It's rise in price of goods and services. So inflation usually refer to the rise in price of goods and services. For example, let's say 1 year ago, it cost you $10 to buy a burger. So this year, let's say it costs you $11 to buy a burger. That's called inflation. The food price went up by 10%. So when you read about articles, let's say, usually it track in year-on-year basis. So when you read about terms saying that in CPI or inflation go up by 10% means the price of goods are 10% more expensive compared to the previous year. So this is known as inflation. So I will talk about inflation-related data later on. So let's move on to the next item. This is the big picture first, then I will drill into the detail one by one. So item number 2 will be the bank issues. So I think some of you may heard of some bank issues recently, especially the famous one like SVB, Silicon Valley Bank collapse, and also the Credit Suisse Bank. So later on, I will also cover some topic on this issue. So overview about the bank collapse issue and the bank issues, and also how does it impact the current stock market. So later I'll cover that as well. And item number 3 will be the central bank updates. So before that, what is a central bank? So a central bank usually refers to an authority or institution that manages the banking system and currency of the country. So their role is to ensure price stability and also support the economy environment, like support the employment and also control the money supply. Money supply here means how many money in circulation in the country itself. So we have a few examples here. For example, in the US, the central bank will be the Fed. The Fed. And in the Europe, it will be ECB, European Central Bank. European Central Bank. And in Malaysia, so for those that are from Malaysia, what is our central bank here? What name does it is? What is our central bank here? Anyone would mind to type in the chat? Yeah, BNN, Bank Negara Malaysia. So they are the authority or institution that control the interest rate. So before we go into interest rate, so anyone would like to type in the chat, what is interest rate? Okay, so an interest rate is when you borrow money, you need to pay a certain fees for the lender. So the lender, when borrow you money, they will collect the interest. And as a borrower, you need to pay the interest. So the interest rate is controlled by all these central banks. So it's the rate you pay for your loan. So for example, housing loan, you need to pay interest rate. A car loan, you need to pay interest rate. And also when credit card, when you have the credit card debt, you also need to pay interest. So all these interest rates are decided by the central bank. So later I'll provide you an overview of the latest central bank updates as well. How is the interest rate look like for all these different countries? And next, I will talk about the US dollars. So because mostly we will invest in US stock market, so we also want to understand how is the dollars looks like currently. And also item number 5 would be indices update. So an indices is a statistical measure that measure a portfolio of stocks that represent the country. So usually we will hear about stock market indices. For example, in the US, we have S&P 500. Then in Malaysia, what we have in Malaysia for our indices, our stock indices. Anyone would like to type in the chat? So in the US, we have S&P 500. And Malaysia, we have the FBM KLCI. Okay. Other than S&P 500, US also has another index that tracks all the tech stocks. It is the Nasdaq 100. Okay, this Nasdaq 100 will track all the tech stocks, 100 tech stocks, not all, 100 tech stocks in the United States. So these are the few key indices we will take a look later on. And lastly, for the update portion, so after update portion, remember I will share with you the opportunities. So the last item for the market update will be geopolitical tension. So as if you let's say you have read around the news in the web portal like CNN or CNBC, you will see from time to time you will see the war in Ukraine, between Ukraine and Russia, and also there is some tech war going on between US and also China. And recently, I think let's say you have read, there is some potential tension between Iran and Israel as well. So I will talk some of this geopolitical tension as well on part number 6. So let's zoom into the inflation related data first. Let's take a look on how is the inflation currently going on worldwide. So this is the overview of worldwide inflation. We just show the key countries because these are the key economy powerhouse. So number 1 will be the US, where it's currently at 6%. So from here, it's gradually coming down. And for the Europe, it's still at 9.9%. It also starts to show some sign of coming down, gradually coming down slowly. And for the UK, it's around 10.4%. Still at a high level, but it's gradually coming down and flattening. And for Japan and China, Japan still at a healthy level, 3.3%. However, China is at 1%. So you can see a red line here showing 2%. 2% is most central banks go. So majority of the central bank actually target 2%. So China are below the 2% target means that they are actually having some economic contraction. Means consumer are less interest on buying stuff. They are saving money or less people are buying things. So it's also not that good for China because it's at 1%. So anyone still recall why in 2022 we have high inflation for US, Europe, and also UK? Yes, we have war in Europe between Ukraine and also Russia. So what does it affect? What does war affect how does war affect the inflation? Yes, correct. War, oil price. So during 2022, actually we have the war in Europe causing the oil price to go up. And also at the same time, Ukraine is one of the top wheat export. So it also causes the food price to go up. Hence, it causes the inflation for US, Europe, and also UK, causing worldwide inflation issues. So in order for the Fed or the central bank to bring the inflation back to 2%, what they can do? So in order to bring the inflation, because the Fed target will be 2%, 2%. So in order to bring down the inflation, they have to increase the interest rates. Okay, increase the interest rate. So they has been increasing the interest rate aggressively. So later on, I will show the interest rate chart. So let's do a quick understanding first. So when interest rate, what cost went up? So when increasing interest rate, the cost of borrowing actually went up. So why the central bank or Fed want to increase the cost of borrowing is they want to slow down the demand. Because when we have inflation situation, high inflation situation, it means that demand is high, prices are going up, things are getting more expensive. So if let's say they increase the cost of borrowing and slow down demand. So why increasing interest rate will slow down the demand? Because it's more expensive to take up loan now. Because when you increase interest rate, the cost of borrowing went up or down. When you increase interest rate, you may answer me in the chat. When you increase interest rate, the cost of borrowing will went up or went down? Will go up. So it's more expensive now to take up a loan to buy a new house. It's more expensive to take up a new loan to buy a new car. And also it's more expensive to take up credits to buy new appliances or renovate your house. So all this will slow down the demand because cost of borrowing is going up already. So what will happen to the listed companies when the demand are slowed down? So just now we mentioned about cost of borrowing went up, demand will slow down. So when demands are slowing down, what is their impact to the listed company here? Okay, the revenue went down. So revenue went down, and also they'll affect their net profit, affect their profits. Hence, the company earnings will drop as well, and the business will slow down. Hence, you can see that over the last year, 2022, stock market has been going down. This is due to people are foreseeing that the earnings may drop once Fed increase the interest rate aggressively. However, now we are at 2023 quarter one. So you can see that from the chart here also, inflation gradually start to come down. So when you see, if I tell you a reason, when inflation going up aggressively, that's why Fed increase the interest rate aggressively. So when the inflation start to gradually come down, what do you think the central bank will do? Will they slow down the rate hike or continue to increase the rate hike aggressively? You may answer me in the chat. What do you think? If let's say the inflation gradually coming down, what is the likely central bank reaction? They will also slow down, potentially slow down, or potentially take a pause, because all their effort previously that trying to slow down the inflation by increasing interest rate starting to show effect after maybe half a year, after 6 months. So you can see that inflation start to coming down. So this is the effect. Usually the interest rate hike effect will show the effect slower. Okay, so we can see that now inflation start to trend down. So central bank likely will slow down the interest rate hike. And remember, stock market is 6 to 9 months ahead of the economy. Hence, you can see that recently investors start to coming in to buy on low valuation. So I will explain more details about it during the opportunity section. So we were expecting a less aggressive Fed or less aggressive central bank when inflation gradually coming down. Okay, so this is the global inflation forecast until 2027. So you can see that the inflation are gradually coming down as per the forecast. So just now I show you the actual inflation, and this is the forecast version for global inflation. So you can see it's per expectation gradually coming down. And as I see some of you ask in the chat, so this is the Malaysian inflation trend. So we are around 3-something%. It's also gradually coming down based on the latest data. Okay, so these are the inflation-related data. So let's take a look on the bank issues itself. So we already know that inflation. So based on the inflation-related data update just now, we can summarize that inflation are actually gradually coming down. So we can still continue to monitor. However, we also, based on this data, we also can expect that there will be less aggressive central bank moving forward. And next will be the bank issues. So I put a few headlines here. Let me launch a poll here, a yes/no poll. Hold on, let me launch a yes/no poll here. Okay, so let me launch a yes/no poll. Okay, so any one of you aware of these bank issues. You may vote yes if you are aware of these bank issues, vote no if you're not aware of it. So the headline like bank runs for Silicon Valley Bank, then financial market fall as Credit Suisse become the latest crisis. Okay, so 62% of you participated. So majority click yes. So 98% of you actually said yes, you are aware of it. So let me explain the storyline about it so you have more clarity on what happened on this bank. And for those no, so you understand about what happened, what actually happens to these banks, why they are suffered the bank run and they are collapsing. Okay, so first we will go through the SVB bank issues first. So SVB stand for Silicon Valley Bank. So the S is Silicon, V is Valley, Silicon Valley, then bank. So let's take a look on what happens. So it all started in 2020-21. So before that, let's have a bit of background about Silicon Valley Bank. So Silicon Valley Bank was the favorite bank by all the startups. So all the tech startups in Silicon Valley actually like to deposit their money in Silicon Valley Bank. So it's one of the favorite bank by the startups. And during 2020 and 2021, we have what event we have in 2020? What is the major event? For globally, what is the major event in 2020? Yes, 2020, we have the COVID pandemic. So in order to counter the recession, all this, so the central bank decide to lower the interest rate and print more money. Hence, that time, the interest rate was only 0.25%, which is very low. So during the low interest rate environment, it's very easy for startups to raise money. They can easily take up loans because the loans are very cheap, 0.25%. Investor also willing to pay them because when you are keeping at the bank, you only get the 0.25% interest rate. However, if you invest in those startups, so all these are big funds, all this, they will willing to invest in those startups company as well, willing to pump money into this startups company or this small startups company. Hence, they were very easy for them to raise money. So once they raise money, they have a lot of cash with them. So they will then deposit into Silicon Valley Bank. So after I secure the loan or secure funding through my investor, I have tons of cash. If let's say I'm a startup. So when I have a lot of cash, then I will deposit into Silicon Valley Bank. So at that year, 2020 to 2021, Silicon Valley Bank actually get a lot of deposits from all these startups. And within 1 year, they suddenly have a lot of cash coming into their banks. And in order to make money through the cash they have to invest it in something other than loan out to all these clients, bank clients to take up the loan because they cannot one-shot loan all the money out as well. So they need to invest in something. So at that time, we are at a very low interest rate environment. So Silicon Valley Bank actually decided to invest in long-term bonds. So why they choose the long-term bonds? Because the 30-year bond will pay them 1% plus versus the 2 years will only pay them 0 point something percent. So we have one jargon here, which is the bonds. So bonds, you can treat it as a type of investment. So bonds, we have bonds here. So you can treat it as a type of investment that where you lend out the money, usually to either a company. So let me draw a C, company, or government, G-O-V-T, okay, government. So the bond instrument usually is like where you lend the money to a company or a government, and you will receive interest. Once you borrow them the money, you will receive interest from them, also known as the coupon rate. So that time you will decide based on the overall market and where is the interest rate looks like. So usually the bond yield will move when interest rate go up or down. So in simple way is whereby you you lend your money to a company or government, in return you'll get a interest payment. And with the promise of, let's say you are talking about a 10-year bond, let's say the bond duration is 10 years. So towards the end of the day, once you start to invest in this bond, so towards the end of the day, if you hold throughout the 10 years, you will get back your initial investment. You will get back let's say you invest $100. Over the 10 years, every year they will pay you a fixed rate of interest rate, let's say 1%. And towards the end, you'll get the full amount of investment back when you hold until maturity, means you hold until the bond terms finish, end of bond term. So you hold, let's say you buy a 10-year bond, you invest 100, every year you get 1% interest rate, then you will get back your full investment after you hold through the 10 years until maturity. So this is how bonds work in simple way, in a high level way. So as long as you hold until maturity, you will get back your original investment. Okay, so at that time, when we are having a low interest rate, so for SVB to make money, so they will invest in the long-term bonds. So for the 30-year bond, you're giving back them 1%. So how they make money is interest rate, you need to give back to the depositor, 0.25%. And they make money through the long-term invested bond, so they will get maybe 1.5%. So from here, they make 1.25% from the delta here. The delta here. So they invest in long-term bonds, they receive 1.5% coupon rate, then they need to pay back their depositor 0.25%. So they get the difference of 1.25% as their profits. So this is how SVB make money during 2020 to 2021, and they make a lot of long-term bonds investment when they receive a lot of cash from all the startups. And then in 2022, what we have? Anyone would like to answer me in the chat? In 2022, how is the inflation looks like and how is the interest rate looks like? Yes, we have war. So as I mentioned just now, we have high inflation, and during high inflation, central bank would need to control the inflation to their target of 2%. Hence, they need to increase the interest rate. So within 1 year, actually 1 year plus, so interest rate hike from at the US is hike from 0.25% to 4.75%. So it's a very steep interest rate hike. So they hike from 0.25% to 4.75% within one year or 1 year, slightly more than 1 year. So SVB start to suffer their unrealized losses in their portfolio. So why SVB will suffer bond losses or the unrealized losses for all their bond investment when the interest rate hike go from 0.25 to 4.75? Because the old bond, let's say the bond that they buy in 2020, so they buy the 30-year bond, so the bond will be less attractive. Let's say now it's 2022, and we have another 30-year bond, another treasury bond coming out. So last time the coupon rate were paying 1.5%. So with the interest rate going up, the new issued bond may paying like 3 to 4%. So which one more attractive now to investor? 2022 bond will be more attractive to the investor. Hence, the 2020 bond will have less demand. Hence, the price will drop. So less people willing to take up the old bond. So the bond price maybe from 100 initial investment may drop to 50 or even 25. Depends on how the demand and supply and also how the bond yield or bond market works. So in a simple way means, if let's say interest rate going up aggressively and the new bond is more attractive, it will have less demand for the older bond. And if you are the holder of the older bond, you need to hold through the full 30 years in order to get back your initial investment. If you sell in between, you will have to realize your losses. And in between, you will see unrealized losses. Means that your current bond, your previous bond that buy at 100 may only worth 25 at this point. So at the same time, when interest rate went up, so the startup also find it more difficult to secure new cash. They are harder to secure new loan now because the borrowing cost is more expensive now. And investors also less willing to give out their cash already because since they put in the bank also they get 4.75%, they don't want to risk their money. Hence, for the startup also, they have less capital to raise. So they cannot, more difficult for them to raise money. However, they also need to sustain their operations. They still need to pay their staff wages. They still need to pay their expenses. They still need to pay their rentals and all their R&D fees. Hence, they start to withdraw money from their account. They start to go to SVB Bank and say, hey, I want back my money because I need to pay my staff. And SVB has to suffer losses for every large withdrawal because they are still having unrealized losses. However, if let's say all these startups never withdraw, they are still okay because what I explained just now is for the bond, as long as you hold until maturity, let's say you buy a 30 years bond, you hold through the full 30 years, towards the end, you will get back all your full investment. If you sell halfway, then you will lose money because you have unrealized losses in between. And when you sell, it becomes realized because it only worth that much during that point of time. So if every big client comes to withdraw their money, SVB need to give their depositor cash, all the cash. So when people withdraw money, they need to give back the cash. Hence, for every large withdrawal, they need to sell some of their bond investment in order to pay back their depositors' their withdrawal. So they need to realize the losses and pay back to them. So for every client that withdraw huge sum of money, they actually need to suffer the losses. And in 2023, during early March, I think it's around 10th of March, SVB management decided to liquidate the entire bonds portfolio. So they're realizing their losses around 10th of March. And at the same time, after suffer the losses, they actually try to raise capital to recoup all their losses. And this actually caused panic because it's in layman terms, it's like, hey, I already do very bad for my investment. Then now I want to raise money from the shareholder. This actually caused panic. And people are fear of insolvency, fear of SVB no longer have enough cash for all the depositors. Plus, at the same time, there are some funds actually advise their client to withdraw money also. Their client, they have a lot of clients in the startups. So some of the fund, they actually have clients in the startups. They actually advise their clients to withdraw money from SVB. So this actually causes a massive withdrawals. Suddenly all the startups go and withdraw money, and also known as Layman known as bank run. So SVB actually suffers a bank run and collapse after they couldn't pay off all their depositors. They're running out of cash. So this is how SVB bank collapsed. So it's a typical bank run where all the depositors go and withdraw the money from the same bank, and the bank end up don't have enough cash to pay back all their depositors. So what is the impact from here? What we can see from here? So we can see from here, most of the depositors. Okay, so first of all, before we go to the depositors, so the depositors insurance only insured up to 250,000. So in US, we have this corporation called FDIC, Federal Deposit Insurance Corporation. So just like our Malaysia, we have PIDM, Perbadanan Insurance Deposit Malaysia, also insured up to 250,000 ringgit. So next time, remember, diversify your savings if you have more than that. And for SVB bank issue, 97% of the depositors actually have more than 250,000 in SVB bank. And it actually impact the startups companies, because if the startup couldn't withdraw their money from the bank account, they will no longer have enough cash also to pay off their employees' expenses, their building expenses, and also their R&D expenses or all their factories. Because most of the startups actually run on losses, because startup means those companies that just initially start their business or initially listed only a small scale company. So usually they were running on losses, and depends on investors' money or money that they raise from the capital raising. So they raise money from all these investor, or they take up loans. So if let's say they couldn't withdraw their money, and they also find it difficult to sustain their capital raising activities like securing loan or getting more investor, they will no longer have cash as well. They're running out of cash as well. So this will create recessions in the economy. If let's say the startup no longer able to run, then they will collapse as well, because they are running out of blood. So all these startups actually rely on the cash flow. Cash flow will be a blood supply for all these startups company. So after this happened, what did the Fed and government do? So Fed actually announced bank term funding programs. So immediately they have very quick reaction. They immediately have some funding programs, then to ensure that all these at-risk bank will have enough cash for them to pay their depositors, and also allow them to sell their longer term asset, for example, the long-term bond, to the Fed, to the central bank itself, without a loss. So means that the central bank come and back up all these at-risk bank, say that you can sell me your long-term asset without losses in order to have enough cash to pay back your depositors. And also government also announced that depositors will be made whole. Means that if let's say you have more than 250K in SVB bank, they'll pay you the whole sum of money without expense of taxpayer money. So this actually calm down the whole market, calm down the whole financial market, especially the banking sector, because the government take very swift and fast reaction to this. And in conclusion, what we can learn from this SVB bank issue? So other regional banks means those smaller banks in the US will be affected, because they are more relying on the depositors' money. So for example, those regional banks, if let's say you're investing in US stock market, better to stay away, because this SVB bank may create trust issue to the regional banks. So the client may go and withdraw. However, those global banks like Citibank, the JP Morgan, Morgan Stanley, all these will less likely to be impacted, because they have wider diversification. So they not so rely on single source like depositors' money. They have wider diversification. They have worldwide clients, and they may benefit as well. They potentially may benefit from all this bank run, because those clients that withdraw money from those regional banks may deposit in the global banks. So they may move from regional banks, move their money to global banks. So potentially all these big banks may benefit. And towards the end, I think recently First Citizen Bank actually purchased the remaining asset, deposit, and loans of Silicon Valley Bank. And the quick intervention by the central bank and also the government actually stabilized the stock market. And with all the turmoil, with all the headwinds, with all the concern in the banking sector, funds actually rotate their money into the tech stocks. Tech stocks means technology stocks. So actually fund moving their money into technology stocks. And next will be the Credit Suisse Bank issues update. So as all of you may know, Credit Suisse actually is a famous bank for ultra rich. They are from Switzerland, and they has been linked with scandals over the years, such as money laundering, corruption, and so on. And the bank has been suffered losses since 2022 with a lot of bad investments, and also a lot of failed investment or poor planning projects or investment and so on. And its project only to recovery in 2024. So they have bad management, they suffer losses in their investment and a lot of bad investment, and also involved in a lot of scandals. And it triggered panic selling after the following events. So at 15th of March, actually, they delayed their annual report due to technical assessment by the SEC. SEC means Security Commission of the US. And Saudi National Bank actually also announced they no longer want to provide any new funding for Credit Suisse. So Saudi National Bank was one of the key investors for Credit Suisse Bank. And they say also, I no longer want to pump new money into the bank. And also the SVB news actually causes the liquidity concern. So people are concerned, hey, will you be the next SVB? However, they managed to secure the funding from Swiss National Bank. It's the Switzerland Central Bank. So they managed to secure the loan from the Central Bank of Switzerland. And at the same time, also with the government involvement and everything, so actually UBS buy over Credit Suisse with the central bank involved. So UBS actually take over Credit Suisse. And so in conclusion, just like the SVB bank issue, the central bank actually and government actually have a quick intervention. So it prevented a further collapse and stabilized the global stock market. So for the bank issue, it actually been stabilized after the swift reaction or swift action by all these central bank and also the government. So for now, it's been stabilized. However, this also causes the financial sector to have more volatility. Hence, you can see that actually a lot of funds rotate into the technology stocks. So let's take a look on the central bank updates for these. So these are the central bank's interest rates, global interest rates. So US at 5% now, US at 5%, UK at 4.25%, China at 3.65%, Europe at 3.5%. Malaysia has been on hold for the last interest rate hike. So we are flat for one round. So we are still at 2.75%. So from here, we can expect a weaker ringgit because other countries actually are still raising their interest rate. However, Malaysia start to pause the interest rate hike. So we are foreseeing a weaker ringgit ahead. However, with the inflation slowing down, so just now the first slide I talked about inflation slowing down. So I draw an eye here, inflation slowing down. And also we have a lot of bank issue. So the bank issue actually causes central bank actually need to step in to intervene to stabilize the market. So from here, based on these two issues, what do you think the likelihood of central bank continue to increase the interest rate hike aggressively? What is the likelihood of central bank continue to increase interest rate aggressively? You may answer me in the chat. Low, so likely they will either one more rate hike and pause or just pause here. So depends on the central bank decision because I don't know the future, but likelihood of continue until this level will be lesser. So we are expecting one more rate hike or it will go flat or pause for a while. Okay, so likely one more rate hike or no increase with all the central bank issues and also inflation coming down. So the coming next few months, inflation data will be crucial. And also we may need to see how is the bank issues going on. But based on the current factors we see, likely is stabilizing with the central bank intervention. So stock market is 6 to 9 months ahead. So you can see that recently actually stock market start to recover due to expectation that the Fed may slow down the interest rate hike due to the slowing down inflation and also all these bank issues. Okay, next will be the US dollars. So this is the USD against ringgit trend. So since most of us here is Malaysian. So based on the data we have just now, Malaysian has been pausing their interest rate hike as well, while others still increase slightly. And with the expectation that US also will be slow down their interest rate hike, we are expecting ringgit will be range bound between the 4.5 range and 4.24 range. So we are expecting a flat or like sideways range bound kind of relationship between US dollars and also ringgit Malaysia. So from here, you can see that how we can gauge the currency strength is you can also based on the forecast or expectation of interest rate hike by all the central banks. So next will be the indices update. Okay, so recently you can see that from the recent charts, NDX is Nasdaq 100. So later I'll show the definition. So let me click one more time. Okay, so we have Nasdaq 100. Recently, you can see the stock chart start to recover. So you can see that it has been on a downtrend throughout 2022. So if let's say you are well proficient with technical analysis, which one of the method we teach in in our workshop, you could have get out earlier during the trend changes when the uptrend changes to downtrend. And now is the best time for you to start preparing for the recovery. So you need to have a systematic way to capitalize on this recovery. And it followed by the S&P 500. So we can see that from the charts here, S&P 500 actually also recovering. And the China stock market are actually still on like sideways of trend over the long big picture. And gold actually recently has been recovery, but over the 10 years, you can see that it actually moving quite flat. And for Bursa KLCI, it's still on the negative side, so it's still not yet recovered. We are still near the low, and it's been sideways for around 10 years. So likelihood of KLCI, why it going is so weak compared to other countries is could be potentially political instability. So we recently have new government, so usually people want to see more stable government. So hopefully our political situation will improve in near future, and also potentially weaker ringgit. So the weaker ringgit will hold off foreign investors to come into Malaysia because other countries are more attractive now. So we may need to foresee these two to have some changes before we can see a recovery from Bursa Malaysia, Bursa KLCI. However, there are still some good stock in Malaysia, but in the US, we are seeing the more predictable and more consistent return. Based on the chart here, you can see that post-COVID recovery, US actually giving the most consistent over the 10 years as well, giving the most consistent company. So we are actually recommending to be invest in US stocks. Why? Because they have also at the same time, other than giving more predictable and consistent return, they also have more well-run companies over there, and it's more regulated as well. So what company that you are known of that what well-run company you known of that are from the US? You may answer me in the chat. What company that are well-run in the US that you known of? Microsoft, yes, Tesla, McDonald's. So all these big brands actually from US. So hence we say that US have more well-run company, and also it's a more mature markets, and also it's more predictable and giving you the most consistent return based on the 10-year data. Because as an investor also, we want our money to be parked at the place where give you the most efficient return. So if let's say you able to pick fundamentally strong stocks, it even can outperform the stock market indices itself. So this is an example of Microsoft. You can see that the recovery recently actually even better than Nasdaq and also S&P 500, and even better than China and other instrument as well, other asset as well. But however, to pick a good stock, you need to do it in a systematic way and also safe way to do so. So you may need to have the knowledge in order to capitalize, selecting good companies, selecting companies that are potentially perform better than the indices. And let's have a look on the overview of the economy cycle. So in 2022, we are seeing that China in recession, Europe also at recession, and US about to enter recession. However, the US employment still healthy based on the employment data, and also currently inflation are coming down. So it could potentially just recover without entering the recession. So we will need to continue to monitor how is the economy doing over there. However, as of currently, the jobs data are still healthy. And also, you can see that even though Q1 2023, UK, Europe, China is still in a recession, China showing some sign of recovery. However, US, like I said just now, the jobs data still healthy. And with China recoveries, it actually will help or benefits the US companies, because China are the second consumer spending, US are number one. So they are one of the top trade partners between these two. So when China recovery, they will actually benefit US as well, such as, for example, Apple, they have huge exposure in China. So China economy recovery will actually benefit US company like Apple as well. Okay, so next will be the geopolitical tension. So as I mentioned just now, the Ukraine-Russia war still happened in Europe. So most likely it already factored in the stock market, since the war has been running for 1 year. And the stock market likely already affecting all the factors unless there are further development happens. So for 2023 is quite normal for investor to face all this geopolitical tension. However, if you know how to select a good stock, or you know which industry to be invest in, then you can always diversify your investment into that relevant industry. So unless there are further development else, I think most likely the Ukraine-Russian war already factored into the stock market. And next we have the US-China tech war. So ongoing from time to time, you can still see some sanctions or ban between the US and China. So what you can do is actually just focus on the good companies to invest in, because now the valuation is low. So I'll talk about the valuation later on in the opportunity section. And lastly will be the Middle Eastern war, where if let's say you notice recent headline, there is some shadow war between Israel and Iran, where their war actually still some bombing or assassination happened in Syria between Israel and Iran on their official. So hope that this one will contain as it is or resolve fast, because if let's say it escalate further into tension, then we will potentially have another war in Middle Eastern. But for now, everything still not so firm up yet. So has some small tension between these two countries, Israel and Iran. But based on now, the market seems like not react to it. So for now, we just continue to monitor this one. So these are the factors that update affecting the stock market in Q1 2023. This is the update for Q1 2023. So we can see that inflation start to slow down. then all the bank issues, then interest rate likely to be slowed down as well because of this slowing down inflation and also all these bank issues. So interest rate hike will likely to slow down as well, and we're expecting the central bank will be less aggressive. And also at the same time, we have the indices also telling us that it's actually recovering based on the chart. And also the global tension, although it's still there, but most likely already factored into the stock market itself. So next portion is, as an investor, we want to navigate the market and see what are the potential opportunities out there. So what are the opportunities here? So valuation are near 10 years low now. And also at the same time, we have inflation actually trending down, and we are expecting a less aggressive Fed, means a less aggressive central bank in the US. And also potential opportunities in the tech sector. So let's take a look on the first point, valuation near 10 years low. Okay, so this is the S&P 500 PE ratio. So over the past, then it's now around the 10 years low. So why I say that the PE of 21 near 10 years low is good valuation now? Because if you compare to the past, before the tech era, company actually less profitable compared to present, where all the tech company are actually very profitable, very good profit margins, and also very good revenues. So they are selling all these software, all these high returns products. So all the high tech companies, all the technology companies actually more profitable. Hence the PE is higher nowadays. Post 2000 technology era, we are expecting companies' earnings to be better, and the PE, hence the PE will be higher, which is quite normal. So based on the data here, it's actually near the 10-year low now, which means it actually show very good valuation for the stocks now. All the stocks, majority of the stocks from the S&P 500 are actually at the very good valuations level, which is near the 10-year PE, 10-year lows PE. So PE means price to earnings. So price to earnings ratio, you can Google about it. What is price to earnings ratio? Usually, this is a way where people evaluate the company by using the price to earnings ratio. So this is overall S&P 500 PE ratio, means like the 500 companies in S&P 500, how is their average PE looks like. So they are at around 20 level, which is at a very good valuation level now. And next will be inflation trending down. We are expecting less aggressive Fed. So usually inflation are tracked by these three key items. Number one is the housing. So you can see that housing price actually coming down. So it also shows that it could be a leading indicator that inflation will continue to slow down. And item number two to track the inflation would be the transportation. However, transportation also directly translate to energy. So what are the key energy we are having here for all our transport is the crude oil. So the forecast for crude oil actually is expecting 2023 to 2024 to gradually coming down or stay flat. So you can see that this also further support that inflation could be likely already peaked, is slowly coming down. And lastly, item number three for inflation would be the food price. So we can see that food price also start to come down. So we are also may see that potentially inflation will be slowed down as well based on these three items. So with the inflation coming down and all the bank issues I tell you earlier, we may potentially expecting a less aggressive Fed or central bank. And lastly, will be the opportunities in tech sector. So the opportunities in tech sector. So from here, we can see that just now I mentioned about the funds start to rotate into the tech stocks. So this is the S&P 500 sector year-to-date performance. So year-to-date means count from 1st January until now. So the data I extracted here is based on 31st of March, which means end of Q1 2023. So you can see that there are 11 sectors in S&P 500. So we have the communication, we have the consumer discretionary. So discretionary means non-essential item, so not so essential item. So non-essential item means like those are handbags, all the expensive branded stuff. So this sector actually recovering as well. Then we have consumer staples, where is the essential item. Energy means all these oil and gas company. Financials mean financial sector. Healthcare, industrials, materials, real estate, technology, and utilities. So from here, based on the year-to-date performance for Q1 2023, actually you can see that tech stock is the strongest. So what are the companies in the technology sector would be like company like Apple, company like Microsoft. So all these are tech company. And we have communication services as the second performing sector. So what are the companies from communication services? We have company like Meta, Facebook. One of their product is Facebook, WhatsApp, and Instagram. So Meta. And we also have Google from this sector, and also Netflix from this sector, XLC. And number three will be consumer discretionary. So like companies like Amazon, companies like Tesla are from these sectors. So from here, we can see that the technology sector actually are recovering. So there are potential opportunity if, let's say, we are expecting a slowdown in interest rate hike. There are potential opportunities in all these three performing sectors. Potential opportunities. Okay, so let's take a look. How I support that is based on the graph itself, based on the stock charts. So you can see that among these three charts, we are comparing S&P 500, Nasdaq 100, and also KLCI, our Bursa Malaysia. So if you draw a downtrend line here, so sorry, my line not that straight. Okay, let me redraw. Let me clear. So if you draw a downtrend line here, you can see that overall, Nasdaq 100 already break above the downtrend line and is recovering. And for S&P 500 also shown some sign of recovery. It also started to break above the downtrend line. And for KLCI, it's still near the all-time low region and been sideways for, since COVID recovery, it's been sideways range bound around this range. So from here, as an investor, we can take advantage of this recovery because all these factors that I shared earlier, valuation, we are at all-time low, 10 years low. And also at the same time, we are expecting a less aggressive rate hike. And also at the same time, I tell you that there are potential opportunities in the technology sectors based on the current recovery data and also based on the stock chart itself. So in order for you to take advantage of the recovery and also navigate the market for opportunities with certainty and peace of mind, you need to have a systematic way. You need to have a versatile way to adapt according to different market conditions. And also you need to have a safe way to do that. So this, I think right now will be the best time for you to learn the skill set itself. So with that, that's towards the end of my market update portion. So Yong Sing, maybe we can take a few chat or I'll pass back to you.
Yeah, I think we can take a few questions. If anybody have any questions, you can feel free to put them in the chat. Oh, there you go. The first one from Layman. With the world slowly moving away from USD currency, will US stocks tumble?
Okay, so recently you could have listened about the news about the BRIC, the Brazil, Russia, India, and China. They're trying to gang up together to trade in their own currency, in renminbi or on their own currency. However, this potentially, in my point of view, it could be a long-term thing because so first question I have will be, who are the world number one consumer spending country for now? Consumer spender number one for the world now? USA. So yeah, US. So at the same time, do you think that in order for renminbi moving from like ranking, maybe because the world number one currency is the US and the biggest consumer market also is the US. So for renminbi to actually move from position number 4 or 5, so I may need to check the data, but it's around there, 4 or 5, to position number 1, it may take years. And also at the same time, renminbi, China actually still need US because they are one of the top export to US, and US actually still need China because they are the world's largest consumer. So based on these factors, it may take years, 5 to 10 years or even more to really compete with the US dollars. And with that long-term view horizon, right, is still the best to invest in US stock market because the currency tumble will unlikely to be huge because usually currency will be controlled by government and also central bank because they have this relationship, export and import. So they will always control the central bank. In between, central bank will always control the currency itself. So for the currency weakening about the US dollars, you can always invest back in the technology stocks or these great fundamental great companies to make back the return because currency loss maybe will be around maybe less than 10%. However, the return you make from the US stocks or good companies or excellent companies will easily outperform the 5 to 10% of currency fluctuations. So for now, and also at the same time, US stock market will still be the well-run and more regulated compared to other stock market as well. So you can actually offset it by investing in the great companies or technology companies in the US to invest to actually hedge back or like make back the currency losses from the weakening US dollars.
Okay, thank you. Thanks, Chye. There's a question in the Q&A from Steven. China markets valuation are more attractive than US and China economy is recovering. So does it make sense to be more positive and invest more in the China markets?
Okay, so first thing is so China market, yes, although the valuation are more attractive, however, most of them are state-run companies, which means one of the major shareholders will be potentially government. And also at the same time, from the past, you can see that we have the Luckin Coffee, where we have the accounting fraud. And also potentially the government, for example, they'll implement policies overnight, like those 共同富裕, like what they call it what already? In Mandarin, they call 共同富裕, means get
common prosperity.
Common prosperity, yes, common prosperity. So this may affect all their stock market. And actually, based on the past data, also you can see that the China stock market are actually quite flat. Yes, although the valuation are attractive, however, they are not as mature as the US market. And at the same time, it's easily affected by the government policies compared to US. The China leaders can come out and overnight policies that totally change the landscape of the stock market itself. And also at the same time, when you want to invest in China, you need to exchange the currency. And the China currency actually is very, very, very tightly controlled by the China government. So this also answer back about the USD currencies earlier. So USD as a currency is still more towards a free trading currency compared to the China currency, where it's more controlled by the central government. So it's harder for the China currency to become the world main currency as well. And at the same time also, if you were to invest in the China stock markets, the stock market will easily affected by the government policies, and also the renminbi will be very tightly controlled by the China government. So even though, yes, very attractive and all this, so you may watch out, like potentially, even in the US, we have the Luckin Coffee accounting fraud. Then even, let's say you want to invest in China market, so make sure you need to be aware of all these factors, and also invest in maybe those listed in Hong Kong rather than in China as well, because it's more regulated compared to US still more regulated as well. If let's say compare this few, and if let's say you invest in those China stock that listed in US, they may still a potential delays and all this over the past years. You can see that when these two countries get tension, they'll have a lot of different kind of policies. So it's easily affected all these stocks. So for now, we still foresee US stock is the most attractive.
Okay, thanks, Lee Chye. There's two more questions from Joseph and one more from Yun Kwong in the chat. Okay, we'll take those three as the last questions, because we are going to close this session in a bit. Now, Joseph's asking, last 2 days, US stock market or tech stock in particular are sliding significantly. What are your thoughts?
Okay, so the last 2 days, it could be potentially profit taking, because over the past quarters, things has been very bullish. So some of the funds may take profits. However, based on the stock chart itself, it's actually shown some sign of recovery. So it's actually very good if, let's say, you know the technical analysis, you have the proficient knowledge and the know-how. It's actually an opportunity when the US, especially the tech stocks, with a lot of good catalysts. For example, recently we have the ChatGPT, we have all these ChatGPT that triggers a lot of demand for all these high-end computing chips, high-end network infrastructure. All these stock that benefits from all these strong catalysts or industry theme, right? It's a very good opportunity during a pullback for you to get in at very good price. So if you know a systematic way with all the proper technical analysis, the pullback actually is a very good sign.
Okay, thanks, Lee Chye. Now, one last question. Sorry, another question from Joseph is latest production cut by OPEC. What is the impact?
Yeah, so all this OPEC actually they've been controlling the oil price, so it could potentially affect some of the inflation indicator, because when they cut the production, means oil price will went up. So worst case, if let's say you see the oil price spiking up aggressively, you can actually diversify some of your portfolio to those XLE sectors stock. Yes, there are still good companies for oil and gas, so you may diversify some of your portfolio, rebalancing it to all these XLE sectors company.
Great. Another question from Yun Kyong in the chat. Why is KLCI still sliding down?
Okay, so KLCI potentially is still political stability there. So not so stable yet, because we have the new government for like almost like half a year only, near to half a year. And also at the same time, we are pausing our interest rate hike ahead of other countries. So our ringgit could be potentially slightly weakened compared to other countries. Hence, foreign fund may not so keen to invest yet with the weakening ringgit. So this potentially means the foreign fund will be rotated out from Malaysia to other countries' stock market.
Okay, thanks, Lee Chye. Okay, one last question for tonight from Coland. What about EV cars, like for example, Lucid and Rivian?
Okay, so for all these EV cars, mostly are startups. So usually startups won't do well during a high interest rate environment. And to capitalize on this recovery, right? So for EV cars, currently what we have all these China branding start coming out. So like BYD, like all these NIO, all these, they are having price war actually. So what do you think will happen to this company when they are having price war? Means most likely they will have lesser margin. So it could not be a very good sector to go in right now, because all these EV companies are actually outfight each other or compete with each other to capture more market share through price war. You can see that Tesla has been dropping their price, and BYD also come out with very competitive pricing. So other startups in the US may struggle to capture more market share and will impact their margin as well. So may not be a very good sector or industry to look at yet. But however, EV is the future, but we may need to see how the price will go, because over the past, like solar industries also, when China government start to pump money into the industry and having price war with the US companies, it actually beat a lot of US companies and capture a lot of market shares through government backing and funding. So we don't know what will happen in the EV cars market yet. But what you can do is actually look at other industry that having catalysts as well, and also not so competitive or not having the price war kind of negative factors.
Okay, so we hope we answered most of your question, if not all. Thank you very much, Chye, for this insightful session. I hope you guys have all benefit from today's session. And if you're new to us, if you would like to find out more about programs and how you can use the knowledge shared by Chye today, right, in your trading and investing journey, do feel free to come join us at our introductory seminar session. We are actually having one in-person, actually 2 in-person sessions in April, right? The first one happening this Saturday at 9:30 a.m. This Saturday, 9:30 a.m. And then another one happening 2 weeks from today, Thursday at 7:30 p.m. So that's April 20th. I'm going to share this link right here in the chat. Feel free to share this link with your friends or anyone who you think will benefit from the seminar as well. The session will be hosted by Kathleen, right, our chief trainer and founder. So if you have already attended it online in the past, or even you can consider attending it in person again, because we have revamped some parts, and best yet, you get to chat with our trainers and team about any questions that you have. Okay, you can scan the QR link that is on the screen right now, or click on the link in the chat. You can also share this link with any of your friends that you think will benefit from this. All right, there's also a limited seats. We have about, I think we can host about 50 to 80 people at our center for a seminar. So go ahead, click on the link and sign up for the session. The session will be in PJ, our training center in PJ, Chye 1 PJ. Okay. All right. Thank you very much, everyone. We are going to close this session in a bit. Thank you. Have a good evening.